Hey everyone, hopefully you're having a good day. My name's Andy. My channel's Finding Value. Today I'm going to talk about one of the comments. It's about paying off your mortgage early. Gives me something to talk about, and it's a good comment. It aligns with Dave Ramsey. But I'm just going to tell you from my opinion, and I've debated with my dad and my brother and myself. I am in the minority. They My dad paid off his mortgage is in about 10 or 15 years. He They refinanced to a shorter duration loan and paid less interest, but his interest rate was still very high. So I could completely understand why you would pay a high interest loan off as quickly as possible. That's exactly what I would do. If my loan was very high, if it was over 5, 6%, for surely I would pay it off as quickly as possible. But I have a loan at 2.75% on a 30-year fixed. Why did I choose a 30-year fixed versus a 15-year fixed? If I were to ever get into a problem, I could always make the minimum payment. I could always make the minimum payment. And the payment, I want to throw this thing as far out to the future with the lowest interest rate possible and not pay it off. Why? Because I want the inflation to eat it away. I know we're at a higher inflation rate than 2.75. I know for a fact. I don't think we've ever been under 2.75 ever. That's why when you look at a lot of things, they continue to go up at much greater rates than 2.75. Now, it depends on the assets that you hold. And if your assets are going up more than 2.75%, you are gaining. You're getting ahead. The best thing you can do is never pay it off in terms of how, paying it off early and just letting the inflation eat it away. Why do I think that? Why is it better to not pay it off? And I'll describe and show you guys why I think that. Now, I'm not advocating everyone do this. I am a pretty frugal guy. Now, I'm not cheap. I just don't spend money if I don't have to. So when I do spend money, and I buy quality stuff, but I don't go out and actively just buy garbage. If it's not going to improve my life, if it's not going to improve my psychological well-being, I'm probably not going to do it. So let me read the question here. It's right here. It says, it's always best to pay off a mortgage first. Always. He's saying always. The biggest two reasons why is it frees up your income to invest more, and most importantly, two, people can lose their job and career in an instant in today's economy. And if you are 15 days behind a mortgage payment, banks can begin foreclosure proceedings on your home. And if you have a lot of equity in your home, the bank can take it. Paying off your home first is always the best strategy as a way to protect equity that you've built so far. The future is too uncertain. I don't know why it went down there. Yeah, the future is too uncertain, and it's time homeowners think about preserving their home equity because banks are right there waiting to take it. And I'm just going to say this. It does not free up your income. If you are trying to pay the house off as soon as possible, and you're dumping extra payments into your house, how liquid is that payment that you made? Can you reclaim it? Can you take it back? You could, I guess, refinance, but that depends on the interest rate in that type of economy, or at that time that you're doing the right refinance. If you have all your equity tied up in your house. And it works great, and it does free up your income after you pay it off. And people can lose their job and career in an instant in today's economy. But if you've been making extra payments, you're less liquid if you've been doing that. I have far more liquidity not having it in my house than I do having it in my house. And I understand what you're trying to say. You're saying that there's equity built in the house, and that if you get 15 days behind in a mortgage payment. Now, here's my question for you back. And I'm just bringing up the question because this is what I would debate with my brother, and he's going to pay it off early, but he's pretty well off. He is. But here's my question back to you then. If you're making extra payments in the house and you have 6 months of emergency savings and you lose your job, you have 6 months of emergency savings if you're trying to knock down your house payment as quick as possible, and you do no other investments. That's what Dave Ramsey recommends. What if someone has a $150,000 loan to pay back and they have 6 months of emergency savings? Or you have 6 months emergency savings plus $300,000 to pay off a $300,000 loan because you've been investing it over that time and you've grown that money. What scenario would you rather be in? The $300,000 was 6 months and you lost your job and you have to pay a $300,000 mortgage. Let's say your $300,000 mortgage at a 2.75 fixed rate is $1,200 a month. How long can you play that game? How long can you protect the equity in your house? Now, if you got $150,000, you've put more equity into the house and you have only 6 months of savings. 6 months of savings in an emergency fund and you lose your job, you're T-minus 6 months from losing that equity. I can go the entire length of the loan and play the game and get a new job and do all this stuff because I'm far more liquid. Now, you could refinance, but what if the rates went up quite a bit? And you have to get money equity out of the house, refinance the house, and then use that to live on if things got, pretty bad. Now, I'm not playing anything that's close. I could pay the house off, boom, no problem. In fact, I have more precious metals than I do in a loan against my house. And maybe that's a good thing. If you keep more precious metals, and I know Ramsey hates precious metals. He hates that. I don't really care. Why? Because they're cheap right now. They're cheap and they'll go up in these market conditions, in my opinion. So that's what I think. I think it's better to have the liquidity. That's what I think. And having the ability to play the game as long as possible. It's okay if you have to pay interest on that loan. Why? Because it's so low and it's less than the inflation rate. So what does that mean? Let's go in here and take a look at what I mean by this. So I did that $300,000, I just grabbed one. $300,000, monthly payments $1,225. Your interest rate's 2.75, and I've assumed a 5% inflation rate. That's the given. 5%. We are far greater than 5%. We are probably at 15%, if you really want to know. This is your payment per year, and your total payment is $441,000, but that's not really what you're paying. If you're choosing a 5% average inflation rate over the 30 years of this loan, and I think that's low. I think we're probably at 8 or 10% inflation. You have a 30-year loan, you discount that back by 5% because that's your inflation rate. You're actually paying back $225,975 today dollars. Now, if you pay that loan off early, this value goes up, not down, because you're paying in dollars that are worth more today than you would be 30 years from now or 20 years from now. So the thing that people have to understand is that tomorrow's dollars are not the same as today's dollars, because today's dollars are the most valuable they'll ever be. So why would you want to pay all of your money back and give the bank all your most valuable dollars and all your most valuable dollars that you'll make over your time? That does not, especially if you have a 2.75 or 2 point something % interest rate, that doesn't make much sense to me. Wouldn't you want to take that money? If anything, if you can get money at that cheap, at a historical low rate, you'd want to leverage up as much as you possibly could if you're a responsible person. You'd want to leverage, and let the inflation eat it away later. That would be the most logical thing to do if you can handle that type of debt. Now, I'm not saying I don't think everyone should be doing that, because it depends on psychology, it depends on the responsibility, it depends on all those things. But by not paying it off, you're paying less. As weird as that sounds. And that was a $300,000 loan, and you're paying it back with $225,000 in today's dollar, or $226 in today's dollars. You're paying it back with less buying power. Less. they're giving you $75,000 or $74,000 to take the loan. I was laughing when I was buying the house because I was like, man, inflation's coming. I don't know. I saw it based off the demographics. So go back to that question again. People can lose. So I think basically what I'm saying is if you're paying it off early and you're making all of your payments against the mortgage early, you're less liquid and you're actually more in danger of losing the equity in the house. I have less danger of losing equity in the house because I can play the game longer than anyone else, even with the mortgage. So, and remember, everything's all relative. It's all relative. And if they're going to inflate, if they're in a debt problem, you have to mimic what they are because they're going to try to inflate that debt away. And I would rather be aligned with them inflating the debt away than be misaligned with them. It's always best to align yourself with those who hold the most amount of debt because they're going to inflate it away. That's what history suggests. So if you have a lot of so I do have a lot of equity in my home too. I have a lot of equity, but I don't have a huge loan. And the best way to protect it is to be as liquid as possible and have as much savings. And the question that I would ask is it better to have 6 months of savings and all the rest of your savings in your house? Or is it better to have 6 months of savings and investments of, let's say, 60 years or 70 years and not have it in your house? Remember, you're taking the most valuable dollars that you potentially could ever make, which is today dollars, and you're paying something down where the inflation rate is greater than your interest rate. I'm sorry, guys. I don't know why anybody would do that. I have no idea why anyone would do that. It makes no logical sense. So, in my opinion, it is always not best to pay it off because of that condition, and it's always best to be the most liquid. And if people can't do that, then that's something that they're going to have to figure out if they can't save money, if they don't have the discipline to do that. And I think that's the whole deal here. It's not getting too leveraged, but it's okay to have leverage if you have the money to cover it. It's okay to use it. Now, I know Dave's background, he went like massively leveraged. He massively leveraged up and he lost it all. So I can understand his situation, but I think you want to do a combination of both things and you don't want to get too leveraged up. Makes sense. But that's my thought. And then this guy responded with, I thought paying down your mortgage early increases foreclosure risk if you lose your job before mortgage is paid off. Using excess funds towards investments that you can liquidate during tough times gives you a cushion. That's what I think. If you use excess funds to instead expedite paying down your mortgage, then you lose your job and miss payments. I don't think the bank gives you credit for prior overpayments and will still foreclose on you. I believe you lose the ability to have a cushion for tough times by paying down early if tough times occur before a loan is paid off. Yep. So what Dave Ramsey is actually, I don't know if he advocates to pay it off early, but you're actually taking on more risk by doing what he's doing. That's why I chose a 30-year loan, a super low interest rate, fixed it for 30 years, and am paying off the minimum amount because I'm actually paying back less. Anyway, guys, if you guys like the content, give me a thumbs up, subscribe to the channel, subscribe to the Platinum membership for the Finding Value website that I have down in the description link. And that's all I've got. So we'll catch you next time. This is Finding Value.